la banca es más que la adopción de tecnologías. Es un cambio de modelo, de un negocio centrado en la sucursal, donde los clientes acudían a un modelo basado en la nube, disponible para ellos en cualquier momento y desde cualquier lugar. Riskmatics presenta la conferencia magistral Global View and Status of Digital Banking. Brett King es un reconocido autor de libros sobre tendencias futuras en la banca y finanzas. Su pensamiento ha sido incluso citado por el premier chino Xi Jinping. Ha realizado presentaciones en más de 50 países en eventos como TEDx, Whited, TechSouth, Singularity University, Web Summit, The Economist, IBM's World of Watson, entre otros. Conduce un programa de radio sobre fintech y es fundador de Moven, aplicación emergente de banca móvil. Asimismo, fue consultor sobre fintech para la administración de Barack Obama. We welcome Brett King to the Digital Banking and Financial Technologies Forum 2021.
Thank you very much. I'm very grateful to be here, very pleased to be here, to be back with you for this. And I have, I think, some gems for to share with you today. And I'm very grateful, again, for the opportunity. Let me jump straight in. Obviously, during the pandemic, we saw a significant increase in digital adoption around the world. This digital transformation that was accelerated by the pandemic, though, we had known for many years this was coming. In fact, really since the birth of the internet, we've seen an increase in digital use. The question is, how has this acceleration around the pandemic changed the adoption of financial services globally? And what does it mean for banks and financial institutions over the next few years? This is really the subject of my discussion today, and that is performing as a bank or financial institution at digital scale in the 21st century economies. Now, if you're familiar with some of the writing I've done previously, I've described this evolution of banking through 4 stages. Traditional banking was Bank 1.0. Bank 2.0 was the emergence of self-service banking. So we are talking about ATM machines, telephone call centers, and early internet banking. Bank 3.0 was the emergence of smartphones and the neobanks and challenger banks. And we're going to see that they're amongst the fastest growing banks in the world today. And then we talk about embedded banking and finance in the Bank 4.0 era, where we emphasize the utility of banking over products. We create these compelling experiences. So the 2 influences here is really the move from physical distribution to digital distribution. This obviously accelerated during the pandemic. People are not going to go back to their old behaviors of visiting bank branches. This decline in activity we're seeing is likely to be permanent. But the real emphasis is on low friction, low latency engagement through digital. Because increasingly, whether it's financial services or whether it's access to healthcare through telemedicine or access to schooling for our children, the 21st century is going to be all about digital delivery and digital ecosystems and digital services. And so banking is just, and payments are just part of that ecosystem that's emerging. This is sort of the evolution we're seeing in banking. So we've gone from the informal banking system to, in most recent times, omni-channel or multi-channel banking. The problem with the omni-channel view is that most banks have treated these digital channels as add-ons to the branch system. And so the branch, is the main reason we've designed products the way we have. A credit card that we send you in the mail with an application form you fill out with a signature at the branch. But ubiquitous embedded banking blows up this model and moves to where we can embed the bank or the utility of the bank in the world around us. And this evolution is sort of really the first time since the days of informal banking that we're revisiting the way banking should fit in people's lives. Branches were the way we did that in the past because they were embedded in the community. But technologies like the smartphone and coming smart glasses really changed the rules around that. So it requires a different ecosystem. This ecosystem obviously includes the technology players that own the operating systems and device infrastructure that delivers 99% of banking today. These are smartphones, internet browsers, smart speakers that you can talk to, and soon, as we're going to be talking about, smart glasses, computers that you wear as a head-mounted display. Obviously, we have an explosion in fintech operators and their influence on the system, and increasingly these brands are becoming household names for users in various parts of the world. We're going to talk about some of those in a moment, and we have the surviving banks. This is what the ecosystem looks like in 2025. Embedded banking experiences powered through the partnership of these three different types of organizations. But I say surviving banks with purpose, because there are a number of banks and payments companies that aren't going to make it in this era. In fact, we think by 2030, the number of banks in the United States will have halved from the peak in 2008. So that's a big shift if we look just at the US, but this is happening in markets all around the world, including in LATAM. So when we talk about fintech in general, Q1 was a big quarter for fintech. It's the biggest funding quarter we'd ever seen in fintech, $28 billion in new funding. But we topped that in Q2 with $30.8 billion or $31 billion of new funding in fintechs. Prior to the pandemic, there was a lot of talk about the viability of these challenger banks, that they were probably going to collapse for the first time they had to face a real crisis. That's not what happened. In fact, exactly the opposite happened. These fintechs have shown that their ability to acquire customers at digital scale was a key advantage during the pandemic period, and hence they grew even more rapidly during this time. And so those of you hoping that the regulator would stop in and finish these upstarts, or that the market would stop funding them, or that when they faced a real crisis they would collapse, none of those things happened. Not one of them. In fact, we had a record quarter of funding in Q2. So what's getting funded? Well, think about WeBank. WeBank is the largest challenger bank in the world. It's based in Shenzhen in China. It's worth $70 billion today, but they have 200 million customers. Now, WeBank only opened their first bank account in Q4 of 2015. And so in just the space of 5.5 years, this bank has added 200 million customers. No branch network ever in the history of banking has been able to achieve anything like this. WeBank's twice the size of JP Morgan Chase's retail customer base with 88 million customers, and they did that in just over 5 years using digital only. They don't have any branches. You can't sign a piece of paper. You know, you apply by downloading an app and opening your account that way. 98% of all customer inquiries that they service, WeBank handles with artificial intelligence automatically. And so, you know, often you'll hear people talk about, well, you know, if you need to see what about if you need to see a human? You know, you're going to need the bank branch then. But WeBank takes a different position on this. WeBank believes that if you have to see a human, the banking system has failed you. It's broken. There's some experience that means that your last ditched effort is to go and speak to a human to try and solve this problem. WeBank doesn't believe those problems should exist. And so they design those flaws out of their system so that you never need to speak to a human. They do have a call center, but as I said, 98% of their customer inquiries they can solve now through the use of artificial intelligence in their chatbot and so forth. In the LATAM space, we have the largest non-Chinese challenger bank globally, Nubank. In June 2021, they received $750 million of new funding. There's talk of an IPO next year on the US exchange, and they've grown beyond 40 million customers now. Both WeBank and our friends at Newbank have shown that their ability to operate at very low operational costs. WeBank's cost of acquisition is just 75 cents per customer, and Newbank's is, generally speaking, somewhere between $5 to $7 US per customer, but sometimes much lower, because they have very strong referral mechanisms through their network. So big raise, $750 million, one of the largest raises we've seen for any unicorn or tech-based company in LATAM over the last few years, if not the biggest. But again, we see a pattern developing here. Their ability to acquire customers at digital scale, having just opened their business back in 2017. Shows the incredible growth that Newbank is getting in a market that is considered fairly digitally immature as yet, with digital accessibility still an issue, but their growth is clear. And over half of Newbank's customer base, their first bank account is with Newbank. So they're doing a lot for financial inclusion, as WeBank has done in China as well. In November, we are seeing the IPO of Kakao Bank in South Korea, raising $1.3 billion in funding. They have 15 million customers there. We have Revolut in Europe with 16 million customers, raising 800 million in July of 2021, almost $1 billion. And in 26, even closer to that $1 billion mark, with a $900 million raise off their 7 million customers in October. Now, N26 could be growing even faster in the German market, but the regulator has restricted them to just 70,000 new customer accounts each month. Why? The regulator was concerned about the market risk because of the such rapid growth that N26 was getting in that market. In fact, N26 is now the second largest bank in the German market by market capitalization. And they're still growing so fast that the regulator has had to, or has seen it fit to restrict their growth. This is not because these banks are small, because they now represent some of the largest banks in Europe, in Western Europe, for example. But these banks are continuing to grow very rapidly, and they, of course, can operate outside of their geographical boundaries very simply because the app is core to their ecosystem. So their digital growth is essentially limitless, in some respects. But, many competitors are saying, what about when are they going to be profitable? And, is the regulator going to continue to allow them to operate? By 2030, what we do know is that these are going to be some of the largest banks in the world, taking market share from very traditional players right now, and doing that at a very low cost of acquisition. This digital scaling component is critical to understand as part of sort of the 21st century shifts we see around digital. And this is why market share is changing and why these will be the biggest banks in the world over the next 10 years. So if you want to compete in this digitally transformed world, you have to compete on the basis of digital scale. Nothing else is going to allow you to maintain market share or grow in these experiences compared with these new competitors. Now, we see when we look at banks who have tackled this problem, there's very few examples of banks who've been successful at fully digitally transforming their business. One example is DBS. They launched DigiBank in India as an extension of DBS Singapore, and they had to, they spent $222 million on this digital banking launch in the Indian market, which has brought them 5 million customers. Now that seems, pretty good investment in comparison to some of these challenger banks, but keep in mind, that they're probably gonna have to continue funding this. DBS may be able to raise money from the market in respect to this, but certainly if you look at expansion, many brands like DBS, and indeed Chase are choosing digital as their mechanism for expansion now. Chase has announced a $750 million investment in their Chase brand, launching in the UK as a digital-only bank. They're partnering with 10x Technologies and Thought Machine in terms of the new core there. This is significant investment we're seeing from leading players to expand into other markets using digital, trying to copy the methodology of the challenger banks. So this is how the biggest banks in the world, or the smart banks, are responding to these pressures from these challenger banks. They are investing in these digital scaling operations. We know, there's acquisition opportunities here as well for fintechs to be acquired by banks. NAB, or NAB as they're known in Australia, spent $220 million to acquire 86400 and their business, to attach that to their digital banking offering in the Australian market, whereas ANZ, their competitor, launched ANZ Plus, to try and compete with NAB. And so we are starting to see banks wake up and realize that digital scaling is going to be core to their competitiveness. But I want to give you one example of where, sort of the behavioral piece of this and design piece is really diverging. Yuibao is the savings feature that's embedded in the Alipay mobile wallet in China. Yuibao is the largest single product or deposit pool in the world in terms of savings. In 2018, it peaked at almost $300 billion of assets under management. The second largest was JP Morgan Chase's US Treasury bond fund, which was half the size. This was so impactful in the Chinese market that the central bank had to put, again, limits on how many people took these accounts and what they deposited, capping it at 20,000 RMB per customer, about $3,000 US. Why the cap? So much wealth was pouring into Yuibao in terms of basic savings that the Chinese government feared that it would affect the capital markets infrastructure there. And so Yuibao is a great example. It's not a savings account in the classic terms. It's a savings feature within the Alipay wallet that was behaviorally based. And so when you start looking at these changes that we see, the challenger banks are only part of the shift. More automation of financial services is going to bring us to products or experiences rather that are differentiated through behavior or geolocation or some triggers and so forth in respect to the ability to acquire customers and be relevant to customers in real time. We see Robinhood exploding in terms of growth during the pandemic. Again, this is digital scaling at work here. The ability to acquire customers is this key ability in changing market share around these leading players. And in the United States, 66% of all new bank accounts opened were opened digitally in 2020. So this really shows that we are seeing a fundamental shift in market share and the makeup of markets around digital capabilities. When you look at the traditional measures of whether a bank is successful, ROE, the number of branches they had, the number of ATMs they have, none of this is really relevant to the conversation of these challenger banks who are growing extremely rapidly without any of those constraints or any of those metrics applied to them. The rules have changed in respect to what makes a bank successful. All of these operators are in the cloud as well. All of these new players operate in the cloud. They have very agile tech stacks. They don't have any legacy policy or process that inhibits their growth. And this is also a key competitive differentiation we see. The ability to partner with other players, tech giants and others in terms of partnership, requires cloud competency as well. So all of the biggest financial institutions in 2030 will be those operating on the cloud at digital scale. And so this is the pattern that we see emerging. But this sort of brings us to the next phase of bank account dynamics in what I call the smart wallet wars. This is essentially how we're going to see over the next few years the battle for the smart bank account as a differentiation going to hit the market. So, you got this great quote that illustrates the sort of change in behavior here. This is a quote from William Gibson, the science fiction author, predicting the decline of cash. And we think he's bang on. He had his cash money, but you couldn't pay for food with it. It wasn't illegal to have cash. It's just that nobody ever did anything legitimate with it. And this is certainly the pattern we've seen in markets like China. In 2014, 98% of retail transactions in China were done with cash. This year, it's going to be below 35%. That incredibly rapid change has just happened in 7 years. If you'd visited China in 2013, though, and told someone that cash would be halved in terms of retail transactions over the next decade, they would have treated you as a mental patient. And yet, this is exactly what we've seen in these markets. Now, in the US, we've tried to adapt to these mobile wallet changes and changes in use of this technology by putting a plastic card inside your mobile wallet on your phone. But this is just iteration on the existing tech and more of an effort to keep the Visa and MasterCard rails relative in this sort of disruptive space. In China, they went a completely different route. They started with QR codes, and this enabled these mobile wallets to grow rapidly. Today, Alipay has 1.6 billion users. Now, if you're doing the math, you realize that's more than the entire population of China. How is that possible? Well, Alipay is already in 150 countries. These are not global wallets only in use in China. They're in use around the world today. And you can, anyone can subscribe to them as long as you submit to the KYC requirements. But in China, they've moved to now new technologies like facial recognition, voice print recognition, fingerprint recognition as mechanisms to secure these networks. But the network effect of these mobile payments is taking place and rapidly ramping up adoption of these mobile wallets around the world. In fact, in 2020, Alipay and Tencent WeChat Pay, just two mobile networks out of China, processed a total of $66 trillion of value through their mobile payments network. Now, that's more than the entire GDP of China, but this is because of the sort of scale of payments that is going through this market. Visa and MasterCard did $33 trillion of value through their market. So already, mobile wallets make up more discretionary day-to-day payments than all of the plastic cards in the world. And this doesn't include M-Pesa in Kenya, PayPal in the US, Paytm in India, etc., that are all mobile wallets experiencing tremendous growth right now. Obviously, in the China market, there's been a bit of a clampdown on the operation of these tech giants or tech fins in the space, but it hasn't slowed down their growth significantly. So if you're hoping that regulators will come in and kill these fintechs, that's not what we're seeing. We are seeing tighter regulation as we learn more about how these fintechs differentiate from traditional players, but we aren't seeing regulators favor incumbents, at least not in most markets. You have a little bit of that in the United States, and that also explains why the US is like 7 to 10 years behind China right now when it comes to mobile payments. Now, you might be worried about security. What about cybersecurity and all of these threats? Well, we just had Singles Day in China. Alibaba did $85 billion worth of sales in a single day. But the fraud rates are tremendously low. Alipay previously published their fraud rates with 0.0006 basis points of fraud off their peak of 460,000 transactions per second. Visa has a theoretical maximum of 32,000 transactions per second. Already, these mobile wallets are far exceeding that in terms of capacity. But 0.0006 basis points of fraud, let's put that in context. Card not present fraud in North America, in Mexico, United States, and Canada is at 11.2 basis points of fraud. That's 10,000 times higher than the mobile wallets in China. Plastic cards are 10,000 times riskier to use for a customer than using a mobile wallet. This is a undeniable fact that we're going to have to deal with in terms of payments and banking infrastructure moving forward, that mobile wallets with biometrics and behavioral heuristics are going to be much more secure than using cash or plastic cards. So that's part of the motivator, but also part of it is the ecosystem. More and more platforms are seeking ways to integrate mobile wallets to give them an advantage, like Gojek in Indonesia, who acquired a bank of their own to build their own mobile wallet ecosystem and financing system for both merchants and consumers in their super app in Indonesia, which reportedly 75% of Indonesians use on a regular basis. We have 500 million players now on the Paytm mobile wallet, mobile money infrastructure in India. Incredible growth we're seeing in these mobile wallets. We see Grab and Singtel cooperating to get a digital banking license in Singapore. So increasingly, we see non-bank players entering the market to try and build banking and fintech capabilities into their ecosystems and give access to their customer base. Singtel had tried a mobile wallet before and failed, but in a partnership with Grab, this ability to provide consumer finance and consumer credit is obviously improved from a context perspective. And even in Vietnam, we see now the fastest growing mobile wallet in ASEAN is based there in Vietnam. So these mobile wallets are going to differentiate as smarter bank accounts, and they're going to do so with better context of how you use your money and helping you manage your money. So if you look at Apple Pay using the Goldman Sachs Marcus capability for their Apple credit card, you can see they show you each of your expenses by category. They geotag the merchant. You can see where the merchant was physically located. You see a little graphic based on the classification of the merchant, and you can see your daily usage of cash and so forth, giving you a lot more context to the way you use your money. This is shown to be very important in changing behavior. So for example, TD MySpend, which TD in Canada launched in 2016, has shown that for customers that use TD MySpend, which gives them an instant receipt every time they swipe their card or they tap their phone to pay, that this has changed people's spending habits significantly. So those users that use the TD MySpend mobile wallet are reducing their spend 5 to 8% per month for those customers that use a standard mobile banking app and a plastic credit card. And it's that feedback loop of awareness of categorization and how much you're spending in dining out or entertainment that is really changing people's behavior so they end up saving more money. Just being aware of what you're spending tends to reduce people's spending habits. And Google's taken this even a step further, where they show you, of course, what you've spent this week and do the categorization, but they also show you upcoming bills or transactions you might have in the future that are going to affect your savings balance. So this sort of predictive cash flow and financial wellness is a key way these wallets are starting to differentiate against passive bank accounts that don't give any of this feedback. Yes, you could log into internet banking and get some of this, but we're talking about active systems that help you manage your money in real time. These are what these smart bank accounts are merging into. So you'll be able to ask your bank account in the future, hey, can I afford to go out for dinner tonight? And it will know the answer to that question because it knows your spending habits, it knows your budget, it knows what you earn, and it knows how much you're likely to be spending if you went out with your friends. This type of context of your spending is going to be really critical to the development of these smart wallets or smart bank accounts over the next few years. We also see contextualization of credit access becoming important. We see these buy now, pay later firms like Klarna and Affirm are now giving you the ability to access credit at the moment of purchase. You don't have to think about it beforehand. You don't have to go to a bank branch. You don't have to sign a piece of paper. You don't have to wait to see if your credit card application is processed. You don't have to wait for them to send you the plastic. You don't have to do any of that. You can just decide on whether you want credit access at the point of purchase. And so increasingly, as we contextualize the utility of banking, products like credit cards will disappear in favor of credit experiences embedded when and where you need them. Maybe a better example of that is grocery shopping. Imagine going to your supermarket and filling up your cart with groceries and getting to the checkout. You present your card. I'm sure some of you have had this before, and the cashier says, "I'm very sorry, sir. Your card has been declined." And so maybe it's because your rent has come out, or maybe your salary hasn't hit your account yet. Whatever the case is, you then have to go looking for another card. Or you might say, "Can you try again?" Like magically more money is going to come into your bank account this time. But for a technologist, we would think very differently about that. We have the capability to deal with this very differently. So we know how much you spend on grocery shopping. We know maybe you spend $300 on your grocery shopping every 4 weeks. But we know today you've walked into the grocery store. We know you only have $150 in your bank account. We know that's not enough. So we can offer you $150 credit to complete your grocery shopping today. We can do that as you walk in the store. So we completely circumvent a credit card product. You don't have to apply in real time. If you qualify, you'll get the message on your phone. If you don't, you won't. But this completely circumvents any competitor that's hoping that if you need a card for grocery shopping, you're going to choose their credit card, because we have a data or informational advantage here. The same is true of car leases in the future. The intent to buy a car is the number one data point, or buying a home and getting a mortgage. The intent to buy a home becomes the number one data point in determining, what you should receive in respect to, say, home financing offers when you walk into a property that's listed on a real estate website. All of that is the contextualization of banking. We won't go to the bank and sign a piece of paper or apply online for a product in this future. The bank will be there embedded with us in real time. And if you aren't building these technology relationships to be able to provide this sort of extended banking, that's the biggest risk you face today, is irrelevance. So data is the new context. That's the single most important data point is why or where does the customer need the bank to solve a problem? And that's really, if you're going to buy a new car in the future, when you walk in with your smart glasses telling you what you can buy or what you can afford, that's all about context. And it's going to change payments radically as well. Will we be using point of sales in the future when we're doing all of this contextual payments? We're not tapping our phone anymore. We're doing this cashierless. We're not using plastic. What's going to happen to the cashier and the way we process payments? Well, you remember Minority Report with Tom Cruise? This is an interesting example of this paradox. We know that technology like biometrics, facial recognition, or in this case, iris recognition, is going to be part of our future in respect to identity. And yet we still have, like American Express, remember, since 2037, we still have American Express pretending that they're going to have cards somehow in this future when you only need your eyes when you walk into a store to pay. In the future, it's going to be whether you walk in with a smartphone or your smart glasses, which determines how you will pay in a retail experience. I'm going to show you an example of that in a moment. We're already seeing facial recognition being used broadly in China. This is part of the reason that fraud has plummeted on the mobile wallets in China. But this is the only way we really keep transactions safe in the future. A 16-digit card number is no longer secure. A CVV code on the back of your card is not secure. Your mother's maiden name, your address, your date of birth, these data points are not secure. We need digital identity for financial services in the future, not just for financial services, but for access to telemedicine, for access to government services, for access to education for our children. All of this is going to require digital identity in the future. But the next technology we're going to see emerging, and it might emerge a little bit later in LATAM, but by 2022, we will see this in terms of both Facebook and players like Apple launching these products into the wild. Project Aria is the smart glasses project that Oculus at Facebook or Meta is working on today. These smart glasses, that you wear on your face, have image recognition and display information in your field of view. Cameras can recognize objects in the real world. So, for example, you could ask your smart glasses, "Hey, do you remember where I left my car keys?" And using image recognition, will recall they were left on the coffee table, and be able to tell you that. When you walk into a coffee shop in the future or a retail store, the payment would happen automatically. The smart glasses are negotiating with the cashier based on your order. You have recommendations from your online world coming into your offline world, and you're using your smart glasses for navigation, for personal safety, all of these things. Embedded in the world around you with this head-mounted display where image is shown in your field of view. Smart glasses will be the next personal computing device. By 2025, we expect that smart glasses in the West will be as popular as the iPhone was back in, say, 2010, in those early days. And this is going to further change or contextualize banking and finances. When you walk into an electronics store in the future, you'll get a message on your head-up display. Don't forget you got to pay the rent this Thursday. That's going to shape your decision in terms of purchases. Or when you walk into a car dealership, you're going to see your financing options. Again, contextually, this is whether it pops up on the smartphone or in your smart glasses saying you can't really afford to buy a Tesla on your current salary. No. But giving you maybe other options that are available. This is the contextualization of financial services. And it's happening not just in retail, it's happening in small business banking and across the board. So you see, for example, with SME banking, where accounting systems are being embedded behind the login, so that you have this entire business service layer built around finances. Or you log into your accounting system and you can move money in your bank account. This sort of ubiquitous access to intelligence, helping you manage your money. And this is going to be true of smart glasses as well in the SME world. Imagine the corporate space being, you're working on a construction project and getting information about factoring, financing for invoices that you have out, or you need additional funding for the second phase of your development. Getting this type of feedback around predictive cash flow will be really key. We see Amazon jumping into the fray here with $1 billion in merchant funding in 2019, but Alibaba, again, really rewriting the rules here with $12 billion in merchant funding, making Alibaba one of the top 5 SME lenders in China today, based on this sort of platform approach to access to banking and finances. This is the ecosystem that's emerging. This is not sci-fi in the future. This is what's happening right now today. So I'm going to leave you with these few messages, and I'll be happy if we've got time to take a few questions. But these are the building blocks of finance and banking from 2025 and beyond. The first is that digital identity infrastructure is needed to secure this. So, that's a risk to consumers. We need biometrics to be able to make payments and banking safe in the future. Paper identity documents like your passport or your driver's license, these are no longer securable in the classic sense because their data points are public, increasingly public data. By 2025, smartphones will dominate banking in every aspect. More people will come into the banking system through a smartphone than absolutely through a branch. In fact, it's probably going to be 10-to-1 ratio by 2025. So if you're still delivering a plastic card to your customers in 2025, instead of giving them access to a mobile wallet to make payments, this is one of the reasons you're going to see your bank decline and your market share shift. More people will get advice every day from their technology around their money than a human in a year. And this is because the best advice is real-time advice, not necessarily human advice. And we can pass on all the advances and all the intelligence that humans have and build them into these artificial intelligence algorithms to be able to give the type of advice humans would. But remember, most of the advice you get from a human in a bank branch is around the bank products, whereas the sort of advice you're going to be getting from smart wallets and bank accounts is contextualization of your money experience, helping you manage your money and being financially healthier. And that's really key, because coming off the back of the pandemic, things like cashback and airline miles rewards for more spending are going to be seen in a negative light, particularly as people are going to have to recover from the financial effects of the coronavirus, which is going to take a lot longer than recovering from the physical effects necessarily. So the ability to help you save money is going to be a critical thing that we see keep being emphasized by mobile wallets over classic plastic card or passbook-based bank accounts. We also see mobile wallets are going to be used for launching cryptocurrencies and CBDCs combined with traditional value stores. In 2022, the Beijing Olympics will be the first Olympics to use a central bank digital currency as its primary currency for activities around the Olympic venues. And this will be through Alipay and Tencent WeChat Pay's mobile wallets, as well as a mobile wallet that the Chinese government itself has created specifically for the Beijing Olympics. So increasingly, mobile wallets are going to give us optionality like cryptocurrencies and crypto custody as a mechanism. Again, if you're a bank and you don't offer crypto custody by 2025, this is going to be another reason your bank will be giving up market share to mobile wallets. We see, obviously, the Cbdc trials are going on. The US has announced 5 Cbdc trials for next year, but no commitment to move forward with Cbdc because they're concerned it will, compromise the petrodollar. But in Asia, we see broad acceptance of Cbdc accelerating there. So Asia's really leading the world in respect to these Cbdc trials, with China being the clear leader globally. So this, we think, means that by the 2030s, that the Chinese digital currency, the yuan, will be the world's reserve currency most likely because of the increasing use of mobile wallets and the fact that the US will be slow to accept, mainstream cryptocurrency at the point of purchase, and certainly CBDCs. So if I'm going to leave you with one message today, I think it's already clear, but let me leave this with you today. The number one competency for organizations that survive and thrive into the 2030s is banks, financial institutions and payment companies, insurers, capital markets players, is the ability to scale digitally. Doesn't matter whether you're Robinhood, Nubank, WeBank, Wise, Revolut, Chime, Varo, Moven. The ability to scale digitally is what is growing future market share for these banks and financial institutions. All of the fastest growing financial institutions in the world today are building their business on digital scale. If you want to compete, you can't compete on the basis of physicality. And that is my presentation for you guys today. This is my new book that came out this week called The Rise of Techno-Socialism. We have a special price on Amazon Kindle right now for $15 for Black Friday. So please consider making a purchase of that. I'm going to stop my presentation there for now and be happy to take any questions you might have. You can put the questions in the chat or have them come through the audience. It's fine.
Mr. King, thank you very much for your insightful presentation. Definitely, as usually, when you give a conference, when you give a keynote speech, you give us a perspective of the issues to come. I would like to put 1 or 2 questions in the few minutes that we have left. You mentioned glasses extensively. Are my glasses going to tell me if I am running over my credit line? Are they going to tell me if I can afford that TV on display in a shopping center? Are they going to tell me if I can buy that new jacket for my trip?
They'll be able to give you those if you wish. I mean, this is going to be configurable in terms of the type of advice you get. We already see this in smart wallets today. So, with the Google Wallet example, Google Pay example, you see that it's talking about predictive cash flow. So, for example, if you had a big new bill, like a new car insurance bill or school fees for the children or something like that you'd forgotten about, or maybe life insurance payment come up and you're not prepared for that, with the predictive cash flow, it might tell you 6 weeks out and say, do you want to reduce your spending over the next 6 weeks so you can pay for this? Do you want access to a line of credit to be able to pay for this? Or do you want to go and drive for Uber or Grab for a few hours to pay for this expense? So really giving you those smarter options in terms of how you manage your money. But one of those things will be, setting savings targets and helping you figure out ways to meet those savings targets. So if you have goals financially, like traveling with the kids to Disneyland once the pandemic is over, or saving up a deposit for a new home or apartment, or things like this, your wallet will be able to coach you on the best ways to do that. This is something bank accounts today do not do. Bank accounts don't give you money coaching. Even the savings accounts are very passive. They just offer you an interest rate on your savings account, but they don't tell you how to save more money. They don't help you change your behavior. And so this is definitely a key element we're going to see in the smart bank account wars, where you're going to see mobile wallets differentiate on how intelligent they are and how they fit your life from a financial services perspective.
Okay. One very quick question. Where is innovation coming from? From the mainstream banks or from the emerging fintechs?
I would say with great confidence that if you look at the truly innovative banks around the world that are setting the pace, there's maybe 2 or 3. But we have thousands of examples of fintechs who are doing this innovation. And so absolutely the incumbent banks are falling further and further behind in terms of innovation. I'll give you one example. I like to pick on them a little bit because I worked with them previously, but HSBC, one of the largest banks in the world in the 1980s and 1990s, today slipping, outside of the top 20 banks in the world, conceivably. But their mobile app for banking, they only released in 2012, 5 years after the first Bank of America, launched their app on the Apple ecosystem. And of course, you've had the emergence of all these challenger banks in the meantime. So I'm afraid the news is mostly bad news, that the incumbents tend to be followers of the fintechs right now, particularly in respect to customer experience, but increasingly these mobile wallet players like Alipay and Tencent WeChat Pay and others are defining sort of the day-to-day money experiences in much better ways than we've seen the banks or telcos, for example, having done that. So definitely, I'm afraid it's not, there's very few incumbent banks that you could count on one hand that are truly transforming digitally. But of course, I've just given you an example of the fastest growing banks in the world today, and none of them are incumbents. They're all these challenges.
Okay. Well, Mr. King, thank you very much for sharing with us your knowledge, your insights. It has been great having you here on the Digital Banking and Financial Technologies Forum organized by Racematics. Thanks a lot.
No problema. Gracias.